And I really believe in this business. This to me feels like Bitcoin in 2012, Amazon in 15, Tesla in 16, Virgin last year. This is an enormous bet for me. And I think that Opendoor is going to build a huge, huge business. And real estate is interesting because this is a category that touches every single American. This is the pillar of the American dream. 68% of Americans own a home. 32% probably want to at some point. 5 million homes are sold every year. This is the largest undisrupted market in the US. It's $1.6 trillion. But despite that, it's completely fragmented. It's low convenience. It's low trust. It's low NPS. And a third of the people in the marketplace actually only do it part-time. So how does this work? You as a consumer can now go to opendoor.com, and within 24 hours, they will give you an all-cash offer for your home. And if you choose to sell within 3 days, you can sell your home. It's a really incredible experience. And so you can start to understand how they can build a really powerful competitive moat. Because the more offers that they're able to make, the more homes that they will buy and sell, which means the more markets they'll dominate, which means the more value-added services that they can automate online. For example, mortgages, title, escrow, all these things where you used to have hundreds of pages of documents they can streamline through a mobile app. Now, that's what got us really excited about the company. But then we took a step back and sort of Buffett and Munger language asked, what's our margin of safety? What can we rely on that allow online buying of homes to grow relatively unimpeded for a long time? And there are 5 really important trends that I think people need to understand. You have 75 million Americans, digitally native millennials, who want to do everything online. They're starting to have families, they're looking for homes, and now they're stepping into the housing market. And then fifth, and probably the biggest accelerant on all of this is, as of a few weeks ago, the Federal Reserve basically told us that they're going to keep interest rates effectively at zero for a very long time. And we think that's going to drive an enormous amount of home ownership and the velocity. So when you put these things together, there's a really important trend that's happening in America, which is that the huge populous states like New Jersey, New York, and California are stagnating and starting to lose people. And these younger, cheaper, more dynamic cities are gaining enormous share. And these are the markets where Opendoor has already launched and is achieving scale. And so this is a business that we think is now very much proven and ready for prime time. They have 70% of the market. So these guys are the dominant leader, almost 4.5 times bigger than their next competitor. Last year alone, they did $4.7 billion of revenue. And 2023, these guys will do almost $10 billion of revenue. If you take the playbook that they have and you just apply it to the markets in which they can expand in the US, at 4% share, this is a business that will do $50 billion of revenue. And it's a merger that really creates an opportunity for investors. We priced this deal at 1 times 2019 revenue, but it's also an opportunity for Opendoor to raise the money they need, fortify their balance sheet, and really create more value and scale. So the last thing I'll say is I want to take a step back and just remind folks of, the times that I've come on, I've really tried to find asymmetric upside opportunities and present them to you, Andrew and Joe, and the rest of the viewers. And I really believe in this business. This to me feels like Bitcoin in 2012, Amazon in 15, Tesla in 16, Virgin last year. This is an enormous bet for me. And I think that Opendoor is going to build a huge, huge business.
Welcome back to the channel, everyone. Back today with another stock analysis. And this time we're covering another one of Chamath Palihapitiya's big bets. However, this time it is Opendoor. We just listened to his investment thesis, or some details around why he thought Opendoor is a big opportunity for investors and himself. There's also another interesting element to this, and it's that Cathie Wood's ARK Invest have been pouring millions into the stock every single day. They increased their position quite substantially earlier in January at around $24 to $26 per share. The stock's now trading at around $27 per share, and they're still buying at this point. They now own 3.9 million shares worth over 108 million in value. Now, this isn't to say that just because ARK Invest have been buying more and Chamath is extremely bullish that we blindly follow them in. We need to do our own due diligence, and we need to see what the risks or concerns are if we are looking to buy this stock. But here's a hint as to why we should probably pay attention when people like Chamath or Cathie Wood publicly get bullish on a stock. And as this stock has now officially merged and the price seems to have settled around the $25 to $30 mark, I think it's a good time to do some analysis and see how big the potential opportunity is. Chamath seems to think that it could be a 10x investment. However, this is from the initial SPAC level, which is more than doubled from this point now. Before we get started, if you're new around here, please consider subscribing and put the notification bell on if you haven't already. Also, if you enjoy the video, I'd appreciate if you leave a like, as this helps the channel out greatly. So what does Opendoor do? Well, Opendoor is an online real estate company. It makes cash offers to property sellers who are wishing to sell through an online process. It then holds the properties for an average of 90 days whilst making improvements and repairs to the purchased property. It then relists the property for sale, and they make money from charging a fee that is comparable to what a real estate agent would collect for closing a sale on a property. They use data science and machine learning to provide a seller with an accurate sale price when compared to comparable properties in the area at the same time, whilst also mitigating the risk of losing value in the back-end process of updating, repairing, and selling the property. The benefits of using Opendoor instead of the traditional sale approach are pretty obvious and quite convincing in my eyes. The process is simple, with a digital experience and liaising with just one person or just Opendoor. You also have greater certainty of closing and the clarity of costs. Also, it's a much faster process. They highlight they can close within 3 days versus 87 days for the traditional approach, which is a huge gap. They also make the process of buying a property much easier and quicker with self-tour homes, financing in-app, and almost completely digitalizing the entire process. So this is definitely a disruptor in a huge market, I must add as well. Now, they hold themselves in the same regard as other major disruptors such as a Netflix, Uber, or Carvana, in the sense that they improve customer experience by digitalizing the process. And I'll be honest, I see customer experience being a huge factor in buying and selling a house, as many of you will probably know and agree. The market opportunity is huge. Real estate, obviously one of the largest markets in the US, and also very ripe for disruption. With the US market totaling 1.6 trillion in sales annually, they segment it down or actually see their potential market as having 1.3 trillion gross merchandise volume opportunity, GMV, which means it's a very, very big market, and even a small capture of that market will lead to success for the company and as an investment from here. Okay, let's look at the financials. So revenue growth has obviously been fantastic. As you can see, they've already hit 4.6 billion in sales back in 2019, and the 3-year compound annual growth rate that you're looking at here is over 140%. The amount of homes they've sold on an annual basis has gone up 6 times in the same period. And this is a type of growth that really gets you excited and speaks volumes to the demand for the product that they are offering. Very good sign in my eyes. And they believe their current playbook could take them to 50 billion in revenue. However, they don't give a timeline or provide a timeline, but 50 billion in revenue in, say, the next 5 to 10 years, or even 10 years, would be something quite remarkable considering where they are now. However, real estate is still very much in its early stages of digital transformation, and if Opendoor or any of its similar companies can be a driver of this change, they could see benefits similar to that of an Amazon or an Uber. Okay, now for the bad news. The margins aren't great. Not great at all, really. And as you'll know, I like companies with high margins, high returns on capital and equity, and this isn't one of them, unfortunately. Although it's not necessarily its fault, it's more the industry that it's in, so it's not a reflection exactly of the company that they are. However, it's the business in which they operate that is a low-margin business. They have to buy a house at full value and then sell it. There's no rental income or leased income or anything similar, meaning there isn't much room for profit besides the fees in which they can charge for the service. This also means they have a very capital-intensive business, which requires a lot of equity or debt to generate revenue. And as we've covered, capital-intensive businesses are more volatile in economic downturns, and in this case, say something like an economic or real estate crash, it could leave the company in a bad state. If they aren't very solvent, it could be a major risk of failure for companies like this. But we'll check their balance sheet in a moment just to clarify that point. I guess one positive is they believe that they can improve margins with scale, and I feel they can. However, they will need to do this for it to be a long-term success. A 7% gross margin just won't cut it, unfortunately. They're looking to introduce ancillary services that will hopefully boost margins. If we go off the information that they've provided, this means that contribution margins could at some point get to around 7%, which basically is sales minus the cost of revenue with any direct and variable costs related to that sale. It doesn't include G&A and things like that, so I'll just be cautious. And they also expect that EBITDA could reach 4 to 6% as a margin in the long term. Not great, but gives us an idea, or at least something to estimate future value with, I would say. And another positive I'd note, the operating costs, they seem to be very efficient in their sales and marketing and general and administrative expenses from what I could see. So this hasn't led, to lack of sales or lack of customers. It's mainly been the coronavirus in recent times, which has driven that revenue down. But this is a positive takeaway in my opinion, and it means that if they can improve the fee structure or boost fees from ancillary services, and that profit margin or gross profit margin goes up, the 4 to 6% EBITDA could be quite easily achievable. Now, Opendoor is very solvent, which is essential for what they do. They have 1.6 billion in cash and not very many liabilities, and this makes me less concerned about the solvency risk, I'll say, but still begs the question how they might thrive in times of economic downturn. Like I've already said, they took a big hit in revenue and homes sold this year due to the coronavirus, with 2020 revenue expected to be 2.5 billion, down from 4.7 this year. We can see that they're projecting that revenue is expected to bounce back and reach 9.8 billion by 2023. However, they're not expecting to be EBITDA positive by this point, which is understandable, I guess, but something to keep in mind and definitely not positive. They see the majority of their growth in the near term coming from existing markets that they're in, such as Phoenix, Vegas, Dallas, Atlanta, and some others, with additional growth in the near term coming from expanding and disrupting new markets in the US and offering those additional services that may eat up that $1.6 trillion opportunity. Okay, now I'm going to use this financial projection they provided and put it into a model of my own to see what sort of value we are getting from Opendoor today. I've estimated past their 2023 projection that growth will slow slightly past that period to 35% until 2026. It will then trail down each year around 5% to the end of the period, which is 2030, and end at 15% growth. Now, the basis of this is that we reach 50 billion revenue in 2030, which is a target they set themselves. I'd take this valuation as an assumption of what the value for Opendoor is today if they can achieve their future projections. This model is also estimating they do reach their 6% EBITDA target by 2030. Again, it could be sooner, but I think 2030 is reasonable. And this gives us a selection of terminal values. I've got a 1.5 times sales multiple there. I've got a 25 times EV to EBITDA multiple. And I've got a perpetual growth method terminal value, which is 3% the growth rate I'm using into infinity, and their weighted average cost of capital, which I included in this valuation, although it's not my favoured method. And I'll do a video soon explaining my choices and reasoning behind a multiple method for terminal values rather than the perpetual growth or infinite growth method. We won't touch on it now, but anyway, we average the three to get an EV of 81 billion or 82 billion, thereabouts, and then a market cap of 83 billion. And this is almost a 6x from the current price, which is nice to see. Unfortunately, not a 10x like Chamath said, although from his price and early investors in the SPAC, it could definitely be a 10x over 10 years. But 6x still a very, very good return. Now, I've got a fair value for Opendoor today at $30 per share. So it's still about 12% undervalued based off of that. I've just used the terminal value in this case, not any of the cash flows throughout the period. It's fairly uncertain, in my opinion, how quickly they can become profitable. And although I've estimated profitability will not come until around 2025 or 26, I think it's best to stay conservative in the valuation, not include cash flow in the fair value process, just because it's a bit of a grey area for the moment. If you're okay with including it and you'd like to include it, then I've got here what your fair values would be. It does boost it slightly. You're looking at a fair value for Opendoor today of around $37 per share or 20 billion for a total market cap, and that would make it 39% undervalued at the moment. I've also got an IRR down here calculation just based off of what the projections above are, and an exit value of $150 per share, which is a price target we have in 2030. And this tells us we could expect a 21% annual growth rate or IRR from a 10-year investment in Opendoor, which is a very, very high return to maintain for 10 years. And if you're comfortable with the assumptions, then seems like it would be a good investment from here. Now, in summary, Opendoor, a great company and product. It's likely it will grow quite profoundly from this point, and therefore investors will see the benefit from it, especially the early ones. I've got to say, I can see why Chamath and Ark are bullish. It fits in well with both of their investing strategies. They believe in also has a lot of upside potential in the current price, to be honest with you. Although I do have some concerns that I mentioned throughout the video. I didn't actually get to cover the concern about competition with the likes of Zilow and RedFin, who are both great companies too and offer similar services with a big audience. So I will leave a list of my concerns in the description below to summarise, and you can do some more research if you would like, just to get comfortable. Of course, this is not financial advice. Again, these are just my assumptions, my opinion, so take it with a pinch of salt. If you enjoyed the video though, please leave a like. Let me know in the comments below what you think of Opendoor, and subscribe to the channel if you haven't already, and put the notification bell on to be notified for the next video. But thanks for watching, and I will see you in the next one.